are IT companies making the move out of China? How's that go?
Well, I would say at the moment it seems that every industry is looking at their supply chains, and certainly the IT industry is no exception to that, given the negative impact of the tariffs. So CompTIA, we actually issued an informal survey to our members, and just basically trying to gauge, the impact again that this is the trade tensions are having on them, and I can provide a couple nuggets from that informal survey. So we are hearing that as uncertainty drags on, many respondents did report that they're at least looking at shifting their supply chains out of China, and they are looking primarily at other Asian markets as well as Mexico. A couple other highlights that I could mention. So again, we talked about this already a bit, but because the margins for tech products are so slim, consumers are always looking for faster, better, cheaper when it comes to tech products. It really is hard for most of our companies to, again, absorb the cost long term. So we are seeing, again, the cost shifting to consumers. Again, that varies company to company for sure. To cope with the impact of tariffs, some companies are adopting an in-China, for-China strategy. And unfortunately, we're also hearing that companies are delaying or canceling investment decisions. So the bottom line, we are seeing some consideration of supply chain alignment. I mean, we're certainly not seeing a decoupling, and certainly hope that, I know we might talk about that in a moment. But again, I think it really does vary. There's a wide variation company to company, and even within companies, product by product.
Thanks, and I guess it really also depends on the size of the company too, and what their ability is. I know we've seen retail sector, a lot of small retailers don't have that ability to shift, don't have the ability to absorb the cost, and that's where you're seeing some of the costs being passed on to consumers that you just can't do that. So we'll get into a little bit more about that as well. So Joe, Chad talked about the overall impact of tariffs on the economy, but can you discuss a little more of the long-term effects on U.S. agricultural trade from the prolonged trade war with China?
Yeah, I guess I went into a little bit on that before, but I think that it is this impact. Just getting to Chad's point, I mean these impacts do hurt China consumers as well, and so when I see these potential for a small deal that China would import a little bit of soybeans, I think, well, naturally, I mean, yeah, sure, they'll bring it in. I think the problem is that it really gets to this managed trade aspect where you're going to bring in, say, here we'll import 10 million tons, and that helps them. But the important thing is it's not the commercials that are doing that. It's their big state enterprise systems like COFCO or Sinograin who are going to import this. They're not doing it. They're doing it essentially tariff-free, I guess. But what you really want is a return to normalcy, where you get back to 3% tariff and let the importers decide when to import and how much to import and from whom to import. And I think that's the danger long run to me, is that I see this shift to South America, which, I mean, let's be clear, if you were to ask me 3 years ago, before this trade war, what's going to happen over the next 10 years, I would say China's going to increase soybean imports, not quite at the rate that they were doing before that, but they're going to continue to do that. Brazil and Argentina are going to get the lion's share of that increase. The U.S. will get some, largely because of productivity gains, that is, yield changes. We don't have a lot of land lying around idle to convert to agricultural land, but we do have yield growth. We have a lot of things like that. But here, I think if what we're going to end up with is some commitment by the leaders to import X amount per year or whatever, I think that's a real bad deal for agriculture over the long run.
Great, thanks, Joe. And I think one of the things that folks aren't looking at as we're talking about kind of the overall impact is that the impact of tariffs aren't in a vacuum. So what happens to the farmer impacts the community. So if the farmer doesn't have the exports, doesn't have the business, goes out of business, that impacts the retailer. The farmer can't go and buy their supplies from the retailer, can't buy a large purchase where they're building a Caterpillar or update their machinery and things like that. So folks need to look at the cyclical impact that tariffs are having throughout the economy, not look sector by sector, because we're all interconnected. So it's something that we know is having a pretty big impact. So as we're talking about retaliation, Cinnamon, well, a lot of focus in retaliation from China is on ag exports. Can you talk about what recent retaliatory actions China's taken that stifle U.S. tech doing business in China?
Sure, so before I answer, I thought I would level set just the importance of U.S. tech exports to the U.S. economy and jobs. So CompTIA does an annual report called the Tech Trade Snapshot, and it actually highlights trends related to tech exports. So I thought I would just throw out a couple stats just to, again, explain just sort of and highlight the importance of U.S. tech exports. So U.S. tech exports directly supported an estimated 858,000 American jobs in 2017, the most recent data we have on that. And during that time period, export-supported jobs grew by 43,000 positions. That's over 5%. U.S. IT exports reached an estimated $338 billion in 2018. That was an over a 2% increase from the previous year. Exports account for approximately $1 in every $4 generated in the U.S. tech sector, and tech exports rank second among all U.S. goods and services in export categories. So again, just to highlight the importance of exports to our sector, and certainly China is a huge market for us. Unfortunately, yes, we continue to face barriers. Some of these are long-standing. Increased inspections, slower customs clearance, slower approval for licenses. Again, this is continuation of long-standing headaches for our members. But in terms of new barriers, I would sort of agree with Chad. It's sort of muted, but we are seeing a return to window guidance where companies are sort of informed unofficially, just don't bother to bid on this project. You just won't be considered. And while Chinese industrial policies, subsidies, and plans to substitute out imported technologies haven't diminished at all, they've sort of gone underground, they're less visible. We think that's just due to the fact that they learned from the Section 301 investigations. So it's just more difficult to assess their impact. So again, I would just say it's more a matter of degrees. The trends that have been long-standing, that are supporting indigenous innovation and calling for secure and controllable technology sourcing. Those are, again, long-standing. But what's happening now, I think, in China is a crystallization around those industrial policies. And again, this is all sort of flavored by the belief in China that, if something's American, it's, quote-unquote, unreliable. And so China needs to be seeking alternative suppliers and ultimately developing their own domestic alternatives.
Great, thanks, Amy. I know, Chad, you talked a little bit about kind of the reason why China has structured their retaliation the way they have. Maybe you talk a little bit more about that. Maybe talk about some of the non-tariff issues that maybe Cinnamon is kind of tapping into as far as what we're seeing or what potentially we see on the horizon.
So I think it's a good point, and it's something, we don't know the full picture. We're, grateful for kind of industry organizations for being able to provide survey information to us to give us a sense for what's going on the ground. The data that we get on a lot of this stuff comes in with a lag. But, what we can say based on the data that, is happening in China right now, it's quite different than how the president portrays things. There's always ebb and flow and entry into the Chinese market for new investments, and then other firms deciding that it's time to leave China because their cost structure has gone up, because they're doing something that's primarily very labor intensive, and China's developing, it's growing, it's getting richer, its wages are going up, and so for a lot of sectors, it may make sense to begin to move supply chains for purely other reasons elsewhere. To Bangladesh or to Thailand or to somewhere else. So there's a normal amount of that going on, but the data suggests that there's still a tremendous amount of new investment that's taking place in China. And I think we have to remember that China is 1.4 billion people, and they're growing at 6+%. And so companies want to be there, need to be there to be able to service the Chinese market in a lot of cases, to be able to produce domestically for the Chinese market. Even frontier companies, that are coming up with new and innovative products that they're going to want to sell globally. They're relying on their global revenues to be able to fund their research and development to come up with those new products. They need to be in the Chinese market. And so I don't think the trade war is necessarily having as big an impact on the Chinese market as the President Trump's Twitter feed might suggest. And it's being mischaracterized a bit that way. And also the sense that this idea of potentially decoupling from China is in any way feasible. The idea that you have to choose them or us is just we saw from the first panel, everybody's interrelated in China, not just the United States, but other countries as well. But economically, that's just where we are. And I think you have to fundamentally recognize that and the importance of that economically when thinking about both evaluating what's happened during the trade conflict, but then also the likelihood of achieving certain objectives that the administration seems to potentially put out there.
Great, thanks. So, Joe, unlike other sectors that have been impacted by the tariffs and retaliation, ag has benefited from compensation payments from the U.S. administration. I think those payments are around $28 billion thus far. I think when the first payments were made, this was going to be a one-time deal. They've now gotten 2 rounds of payments. This could increase depending on how long the trade war goes on. Obviously, with an election coming up, the president wants to keep favor with the farmers, even though we're hearing more and more on a daily basis farmers who are being harmed and being upset by this ongoing issue. We know that ag would prefer market access and sales instead of this kind of cash payments support. Can you talk about how this aid has affected the ag sector and what are the downsides to the continuation of this kind of aid?
Yeah, no, thanks. I think there's probably other sectors that wish they had a Commodity Credit Corporation Act that could dole out $28 billion going up an eye. It's very easy to feel sympathy for the ag sector. They were hit hard. I think the prices were down not just for soybeans but for other commodities. If you look at the farm income numbers that USDA just released, if you look at receipts and look at some of those measures, they were all down. Farm income actually ended up being up. Why? Because of these compensation payments. I have a lot of concerns with the payments themselves. One, in all fairness to USDA, the president announced this, and I think a lot of people were caught off guard. I think the secretary had said a few weeks prior to that no, he didn't see any, that there wasn't going to be any aid forthcoming or whatever, but then all of a sudden you had this package, and so they had to put together a package very, very rapidly, and they did it on the basis of sort of the lost value of U.S. trade, which is an interesting measure, but it's not really lost income. And if you look at some of the analyses that independent economists have done and others, they suggest that the payment rates are a little on the high side for under these compensation packages. Our farmers will tell you, on the other hand, that they are looking at the long run. They're thinking that these losses will last over a long run, so they're more than happy to take bigger payments up front. But the problem becomes is do these things distort production? I mean, this is a lot of money, $28 billion given to a sector. The first the payments that went out for the 2018 losses came out in July, so after planning time, so no effect on planning, was seen to be a one-shot deal. But then all of a sudden, before we're in springtime, before the 2019 crops are planted, we're talking about yet another package. And there, I think there got to be a lot of concern. I think USDA did its best. What they ended up doing was doing a per acre payment that was applicable to any number of some 40 some odd, well, no less than that, but 20 some odd crops. If you were within that county, you got the same payment. So it didn't distort between the crops, but you had a plant to get that full payment. And so I think that's, obviously does cause some distortion. I think people feel that probably some land was planted that may not have been otherwise. But that sort of brings me to the second issue, is how those payments then are viewed in places like Geneva. I mean, U.S. has obligations under the WTO, under the Uruguay Round Agreement on Agriculture. Insofar as domestic support measures are capped at agreed upon levels. I think that the 2019 payments are going to be pretty close to those limits. you know, whether or not someone takes a case against us or whatever, that will all play out. But I think the more troubling thing is just what it does to the U.S. stature in Geneva. I mean, we remember this administration, or the previous administration and this administration, pushed a case against China, saying that they had domestic support measures that were distorting production. They won that case, a very important case, just got a ruling on it just months ago, and China agreed to implement it. And yet, here at the same time, we're doing this sort of do as I say, not as I do kind of action. And I think that, is unfortunate. And then lastly, I don't know, maybe I'm too harsh, but it seems to me a real moral hazard problem, in the sense that you have a sector that's really being hurt, and they would be normally the ones who'd really be complaining. But you give out $28 billion and say, don't worry, I'm your pal, I'm still going to be behind you, we're going to beat these guys, here's another $28 billion. I mean, again, if only, you know, the tin can industry or whatever had a CCC Act for them. I mean, there's just a lot of people that are hurt by these trade things, and to reward one sector, I think, unfortunately, just promotes bad policy.
Thanks, Joe. I think, you know, this is the ongoing concern that we hear is, you know, well, we're doing this, you know, short-term pain for long-term gain. How short-term is this going to be? You know, when are we going to get a final deal that, you know, makes everybody whole, or at least gets back to normal, or at least gets the trade relationship back to where it needs to be? So, Tim, you know, you talked a little bit about, you know, the ongoing issue of some folks wanting to decouple, you know, the relationship between the U.S. and China. Can you talk a little bit about how, you know, why such a fundamental shift from China is unrealistic, and the impact it would have on tech and consumers?
Sure, yeah, we are concerned with the increased rhetoric around this concept of decoupling. You know, the idea that we would sever the integrated supply chains of the two world's largest economies. Again, I'll align myself with my panelists here. We don't think it's realistic or good for our country. You know, our temperature, you know, we definitely, our concerns rise when we hear news reports that, you know, the administration may be looking at potentially moving Chinese companies from the U.S. stock exchange, when we're seeing tweets from the president basically urging U.S. companies to start looking for alternatives to China. Of course, there are also, you know, there's activity within the administration, such as pending rulemakings on export controls for emerging technologies and foundational technologies. And then there's just sort of the overall tenor with respect to immigration and some of the policy shifts that have made it harder for high-skilled workers in the U.S. So again, yes, back to your question, I want to reiterate what Chad was mentioning, which is, again, you know, given the cost competitiveness of manufacturing in China, again, we have supply chains that have been built up over decades. You know, years of investment in capital, in personnel and processes. Again, this concept we just don't think is at all realistic. And we don't think it's good for the country. You know, China supports roughly 2.6 million jobs, American jobs. You know, some of those are jobs that China has created in the U.S. Again, as Chad mentioned, you know, the Chinese middle class is growing very rapidly, and that really does provide an opportunity for U.S. companies to tap into that lucrative market, and of course that just will boost U.S. employment and growth. Economic data shows that nations that trade closely with China do outperform nations with less integrated ties. So again, for all of these reasons, we do think that, you know, this idea of decoupling simply not good for the U.S. It's certainly not good for consumers. And again, the IT sector in particular, which I think we all agree we'd like to be the strongest and most innovative in the world.
Thanks, Amy. We're going to turn the audience in just a second for questions, but Chad and Joe, anything else you guys want to add on the decoupling question? Thoughts on Chad, you addressed a little bit earlier. So, okay.